Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, and I've returned today to whap and tap on your head with another ADH Wealth Solution article. Before I go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, to contribute to channel growth, or to schedule an appointment with a licensed financial professional, the links are in the description of this video. Today's article is Term versus Whole Life Insurance by lifeinsurance.org. Should I choose term insurance or whole life insurance? With the rates for term life insurance being at all-time lows, many financial and insurance experts agree that term life insurance is a good choice for most individuals. But before we discuss why that may be the case, let's take a moment to review the differences between term insurance and the most popular form of permanent life insurance, whole life insurance. Term life insurance is a death benefit only life insurance policy that you purchase for a set length of time, usually either 10, 20, or 30 years. If you die anytime during the term, your chosen beneficiary receives the full amount of the death benefit. However, if you die even one day after the term, your family doesn't receive a dime. So when purchasing a term life insurance policy, it is important that you not only determine the apropos benefit amount, you must carefully figure out the length of term. Pause, ladies and gentlemen. The most commonly sold term life insurance policy is a 20-year term. The problem with that is that, especially when they tell you to take a strategy of buy term and invest the rest, it generally is telling your family that you plan on dying in 19 years, otherwise they don't get anything. Let's continue. Whole life insurance, on the other hand, is what is referred to as permanent life insurance. There is no term limit, and it remains in effect until the day you die, so long as your premiums and other policy obligations continue to be met. In addition, such permanent life insurance policies have a cash value. There are other forms of permanent life insurance such as universal life and variable life insurance, but for the sake of this comparison, we will restrict our discussion to whole life, as the differences between whole life and others are subtle. Whole life insurance policies are much more expensive than term life insurance policies. This is mainly because with a whole life insurance policy, a portion of your monthly premium is invested in a tax-deferred account or savings plan. Thus, the policies build equity and funds for retirement. However, many financial analysts say that life insurance may not be the best investment for retirement savings. They suggest people purchase a term life policy and invest the difference in monthly premiums in some other tax-deferred savings plan, which often have greater yields. There are those who feel, at least with whole life, you are getting something besides the insurance. In other words, with a term policy, suppose you outlive the term. You just paid tens of thousands of dollars for nothing. To try to make up for this disparity between term and whole life, many insurance companies have recently introduced a product called Return of Premium Term Insurance. Return of Premium life insurance is exactly like term life insurance with an added bonus. At the end of the term, you receive the entire amount of premiums paid over the life of the term. So if you buy a 30-year return of premium life insurance policy and you've been paying annual premiums of $1,000, if you're still alive after 30 years, you'd receive $30,000 back from the insurance company. Such return of premium life insurance policies cost more than standard term policies, but many people find them attractive for their nothing to lose scenario. But again, savvy financial advisors point out that one could conceivably invest the rest between the cost of standard term life and premium return and see a return of more than the give back over the length of term. Pause, ladies and gentlemen. A lot of those financial advisors are telling you that because they get paid off of what you invest with them. And the difficulty with an investment, while you may get a higher yield, the thing about investing in speculative investments is The average rate of return over 20 years is about 10%. So if you put $100,000 in, the average return after that 20 years is $10,000. So you put $100,000 in the market and you're only going to come back with $10,000 in return. And that's not guaranteed. So the investment might do better, but it might do worse. And to be honest, oftentimes most investments don't go to the moon like your crypto supposedly is. Let's continue. In summary, for most people, a term policy is a good idea. But that is not to say that there aren't some people for whom a whole life policy would make more sense. It's best to discuss your needs and life circumstances with an insurance professional who can help design the life insurance product that is best for you. That's going to be it for today, ladies and gentlemen. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. With that being said, ladies and gentlemen, wipe ass, work in progress every day and see success. And remember, folks, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Except the challenge. Actually, before I stop, ladies and gentlemen, I'm a person who's not a fan of term life insurance or whole life insurance. I'll break down to you why. Again, with term insurance, you're basically telling your family you intend on dying, and if you have a 30-year term, you intend on dying in 29 years. If you have a whole life insurance policy, even though it builds cash value, it robs you, the client, of your cash value should you die. For example, if you get a $100,000 whole life insurance policy and you build $50,000 worth of cash value and die, the insurance company is only on the hook for $50,000 of their own money. I prefer indexed universal life insurance because the way you can structure it, if properly structured, when you build up $50,000 of cash value in that $100,000 policy, and God forbid you die, your family not only gets $100,000 of the insurance company's money, but the $50,000 of cash value that you've saved. So again, that's going to be it for today, ladies and gentlemen. Wipe ass, work in progress every day and see success. Salute.